Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing AT&T stock so we can determine if it's a buy or a sell. AT&T is one of the largest telecom companies in the world. It sold its Time Warner division to Discovery in 2021. The name of the new entity is Warner Bros. Discovery, ticker WBD. Its market cap is $28 billion. And this company does not pay a dividend. The main reason for the divestiture is to become a pure play communications company similar to Verizon and T-Mobile. Also, the margins are higher for its communications business versus its Warner Bros. Division. AT&T is headquartered in Dallas, Texas, and was founded in 1983. Let's get started with the model. This is a large cap company, 111 billion market cap. They're trading at $15.50 a share, and they have 7.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Before they sold Time Warner, they had tons of free cash flow, $27 billion in 2020, dropping to $25 billion in 2021. Then they spun off Time Warner, and now they have $12 billion of free cash flow in 2022, but it's growing. It's almost $14 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative each year except 2021. Lots of write-downs because they tend to overpay for companies. When you overpay for a company, that means you book goodwill onto your balance sheet. Then years later, they impair the goodwill, meaning they reduce the goodwill on their balance sheet, they reduce the asset, and pass through the loss onto their income statement. That's called goodwill impairment. They also have a lot of fixed asset impairments because they have a ton of infrastructure on their balance sheet. Revenue is a sales for the company, and that was around $170 billion with Time Warner. Without Time Warner, it's around $120 billion. A few weeks ago, they released their first quarter earnings. Let's go through some of the financial information they released. They give a lot of breakdown of a lot of different information. And these slides show the 4 quarters in 2021 with the sum of 2021, the 4 quarters of 2022 with the sum of 2022, and the most recent quarter, the first quarter of 2023. Their operating revenue in the first quarter of 2023 is $30 billion. If you go back 2 years to the first quarter of 2021, it was $36 billion. Hopefully, with the divestiture of Warner Brothers, it leads to greater free cash flow and greater profitability in the future. Right now, their revenue is lower, which doesn't mean they're doing worse. You have to look at profits and margins. Their cost of revenue in the first quarter was $5.7 billion. 1 quarter ago in the fourth quarter of 2022 was $7 billion. Same thing in 2021. In the fourth quarter it was big, $7.4 billion. It seems like they spend the most money in that quarter. In 2021 they spent $8 billion in broadcast, programming, and operations. That's for Time Warner Bros. Media. Now you can see they're not spending any money. It's zero the last 5 quarters. Other cost of revenue is $6.7 billion. Then you have selling, general, and administrative expenses, $7.2 billion. This is things like marketing and payroll. And they have lots of fixed assets on their balance sheet, so depreciation and amortization is high, $4.6 billion. Total operating expenses, $24 billion. Last quarter it was $52 billion. The reason it was so high last quarter was a $27 billion goodwill impairment from Warner Bros. Media. And that's a non-cash item. So it does bring down your net income, but it doesn't affect cash flow. That's why they had a huge operating loss in the fourth quarter of 2022, a loss of $21 billion. They had a gain of $6 billion in the first quarter of 2023. $1.7 billion of interest expense, that's the interest they pay on their debt. And that's higher than every quarter until you go back to the first quarter of 2021. It was $1.8 billion. Their net income for the first quarter was $4.5 billion. Last quarter was a net loss of $23 billion. Their EPS in the first quarter was 57 cents. That's earnings per share. The calculation is net income over shares outstanding. Their EPS in 2021 averaged about 67 cents a quarter, but that includes Warner Brothers Media. They have 7.16 billion shares outstanding. They pretty much have the same shares outstanding for the past 2 years. So they're trying to keep that steady. It would be nice to see the shares go down, but at least they're not going up. Their EBITDA is 10.6 billion. That's earnings before interest, taxes, depreciation, and amortization. But it's hard to look at numbers on a nominal basis. It's good to look at margins. So the EBITDA margin is EBITDA over revenue. And they're converting 35.1% of their revenue into EBITDA. When they had Time Warner, they were averaging under 33% EBITDA margin. You can see their margins are improving now without Warner Brothers, and they're probably going to get better. The next slide in their report is consolidated statement of cash flows. Let's first look at operating cash flows. The purpose of operating cash flows is converting net income into cash, because net income is your accounting profit or loss. It's not actual cash. The way to calculate operating cash flow, you start with your net income, 4.5 billion in the first quarter. Then you add back depreciation and amortization, since that's a non-cash item, 4.6 billion. Then we add back $500 million. This is a reserve they put up for the money they think they will not receive from extending credit. To put it a different way, the amount they won't receive from providing accounts receivables. We add back 500 million in deferred income tax expense. On the income statement, they posted a pension credit of 670 million. We minus that out here. Then we have to adjust for changes in working capital. They had a cash inflow of 600 million from receivables. So they extended credit in the past, and those customers are paying now in this accounting period. It looks like they used credit in the past. They used accounts payable. Now they're paying it back. They had a cash outflow of 3.4 billion in accounts payable. Even though they reported an accounting profit of 4.5 billion, they actually generated 6.7 billion of cash flow. Last quarter, they reported a loss of 23 billion, but generated over 10 billion of cash flow. Remember, we have to add back that impairment. It's a non-cash item. The goodwill impairment on Warner Brothers Media. They also had a cash inflow of 2.2 billion from accounts payable. But it looks like this most recent quarter, they paid back that accounts payable. That's why it's a negative. In the third quarter of 2022, they also had over 10 billion of cash flow. A little over 7.5 billion in the first quarter and second quarter of 2022. Let's look at the next two sections on the statement of cash flows. Investing and financing. In their investing section, they spent 4.3 billion of CapEx. Most of that is the infrastructure for the telecommunications business. They spent almost 300 million in business acquisitions. They received 774 million from DirecTV. AT&T owns DirecTV. And this is some of the distributions DirecTV gave to AT&T. You can see each quarter they give them money. In the first quarter of 2022, it was 1.3 billion. So in their investing section, they had a cash outflow of 3.8 billion, similar to last quarter. It was highest in the first quarter of 2022, 12.5 billion. That's mainly from acquisitions. They spent over 9 billion in acquisitions. In their financing section, they took on debt. They added 3.6 billion of debt. That's a cash inflow. And that's short-term debt. Long-term debt, 3.4 billion they took in. They repaid 5.9 billion of debt. They repaid 2.1 billion in vendor financing, and they paid out 2 billion of dividend payments. So in their financing section, they had a cash outflow of 3.7 billion. You can see in the second quarter of 2022 a cash outflow of 44 billion. That's because they paid back $35 billion of long and short-term debt. They got that money from the spin-off of Warner Brothers Media. So they used most of the funds from that sale to pay down debt. And they need to pay down debt. They have a ton of debt. The next slide is their free cash flows. And they break this down by quarter in the last 9 quarters. The way you calculate free cash flow, it's cash flow from operations minus capital expenditures. So they didn't have much free cash flow in the first quarter, only 1 billion. But last quarter it was over 6 billion. Hopefully this most recent quarter is just an off quarter and they're able to generate a lot more free cash flow in the future. Because that's how they pay the dividend payments, with the free cash flow. This slide is some more statistics. It shows their CapEx for the last 9 quarters, 4.3 billion in the first quarter. The FCC held a spectrum auction for C-band licenses. They paid $22.9 billion in the first quarter of 2021 and $9 billion in the first quarter of 2022. You can see they cut their dividend. It was 52 cents a share. Now it's down to 28 cents a share. Their shares outstanding are barely up from 7.14 billion in the first quarter of 2021 to 7.149 billion in the first quarter of 2023. Their debt ratio went up from 49% to 56%. The way to calculate debt ratio, it's liabilities over assets. If the debt ratio is 100%, that means liabilities equals assets, which means the company would have no equity. If the debt ratio is above 100%, then liabilities are greater than assets and the company has negative equity. If the debt ratio is below 100%, like in this example, that means assets are greater than liabilities, which is what you want. Lower is probably better for this number. Their employee count has been going down over the years. It was 191,000, now they're down to 158,000. It's not good to see employee count going down, but still, that's a lot of employees. Now let's look at a breakdown of their revenues. Communications revenue, $29 billion. $21 billion from mobility, that's their bread and butter, their phone service. $5.3 billion from business wireline and $3.2 billion from consumer wireline. Wireline uses cables, mobility is wireless. Latin America and Mexico, $900 million. That's their most revenue ever in a quarter in this region. Corporate, $104 million. That's down a lot from prior quarters. Total revenue, $30 billion. That is up when you compare it to the first quarter of 2022. Of course, it's down from the first quarter of 2021 due to Warner Brothers Media. They didn't get this $6.7 billion. In their communications segment, operating revenue of $21 billion. Services, $15.5 billion. I pay for their services. I have an AT&T plan on my phone. They sell equipment. That was $5.1 billion. It was higher last quarter of $6.1 billion. You can't compare to last quarter. You got to compare to the first quarter of 2022. And it's down also. It was $5.35 billion. But it is up from the first quarter of 2021. It was a little under $5 billion then. The expenses directly tied to generating the $21 billion are $14.3 billion. So they have operating income of $6.3 billion. Margins of 30.5%, EBITDA of $8.4 billion. The EBITDA margin is 41%. EBITDA service margin 54%, which are a lot higher than last quarter and also higher than the first quarter of 2022. For their communications business, total subscribers, 223 million. That's their most ever. It was under 200 million in the first quarter of 2022, so that's a really positive sign. 112 million connected devices, a lot higher than the first quarter of 2022, and it's up 4.5 million from last quarter. They added 5.1 million subscribers in the first quarter. They add a lot each quarter. They added over 7 million in the third quarter of 2022. Their postpaid and prepaid phones are the highest ever, 70 million, 17.5 million. Their postpaid churn is under 1%. Churn means people who stop using their service. Prepaid churn is almost 3%, but that's a lot lower than last quarter. Last quarter was 2.87%. That means about 3% of their customers stop using their service. The annual revenue per user is $55 in postpaid phone. It's $34 in prepaid phone. Looking at this slide, things look promising. In their business wire segment, revenue of $5.3 billion. That is down from prior quarters, so it looks like an area they're lagging. Expenses of $5 billion, so they don't have much operating income under $400 million. Really low margins, only 7%. It used to be higher, it used to be 14% in the first quarter of 2021. EBITDA of $1.7 billion, EBITDA margin of 32%. Let's look at their capital structure. $99 billion of equity, $156 billion of debt. They're 39% equity, 61% debt. I think they have the most debt of any company in the world. Their net debt is $153 billion, so they only have $2 billion of cash on their balance sheet. I gave them a WACC of 9.3%, WACC is weighted average cost of capital. That's how much it costs this company to obtain financing through debt or equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $196 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $178 billion. We divide that by 7.2 billion shares. And we get a calculated stock price of $25. They're trading at $16, so they're trading at a 38% discount. It's a strong buy according to the model. Simply Wall Street is way higher than me. They're at $46. They say the stock is 66% undervalued. 11 analysts price this stock, and the average price target is 23. The low is 18, the high is 28. Another 22 analysts price this stock, and the average price target is 21. They say the stock is 38% undervalued. This is where the stock has been trading since 1995. It was about $16 in 1995, pretty much where it is right now. And then by 99 it hit its highest point, about $44. Then over the next couple of years, mainly due to the dot-com crash, it came way back down. Then in 2007, it broke through 30. Then the Great Recession hit. It came back down to about 17. Then it took about 8 years until 2016 to break through 30 again. And then in the past 6 years, it's pretty much only gone down. It's been trading below 20 for a year and a half now. But most people who own this stock do so for the dividend payment. Some people have held this stock for decades and have been paid back multiple times just in dividend payments. They were paying a 52-cent dividend before they sold Time Warner, then they cut that to 28 cents. But since their stock has come down, the yield goes up. Now the yield is over 7%, which is a great yield. And they are consistent. They always pay a dividend. They never miss a beat. And they could afford that dividend. It's only 58% of their free cash flow. And we can't look at the dividend over net income since they have negative net income from all those write-downs. There are 50 companies in the same industry as AT&T, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a lot on CapEx, second most on this list. Verizon is the most at $23 billion. They're at $19 billion. These are investments in property, plant, and equipment. It's mainly in their telecommunications infrastructure. They have a worse debt to equity ratio than the median, but a little better than the average. They pay a really high dividend. Look at Vodafone, 9.7%, and Verizon, 7.3%. The average is 1.9%, the median is 3.9%. They generate lots of free cash flow, almost $14 billion. The only one that generates more is Verizon, $15.4 billion. They rank 4th in market cap, but for a while they were always number 1. Their price to book is better than average. Price to book is market cap over equity. Equity is on the balance sheet. It's assets minus liabilities. We can't look at their PE. They have a great price to free cash flow, 8.1. If you bought the stock today, you'd be paying $8.10 for each dollar of cash flow. Price to free cash flow is market cap, that's the P, over free cash flow. Price to sales is 0.9. So investors are paying 90 cents for $1 of revenue. That's market cap over revenue. Since it's 0.9, since it's below 1, their revenue is higher than their market cap. If it was above 1, their revenue will be lower than their market cap. Their 5-year annual revenue growth rate is negative because of the spin-off of Warner Brothers. But if you strip that out, I'm sure it's positive, but probably not too much, like 1 or 2%, like Verizon. Let's go through some of the slides in their press release. This is the press release for the first quarter of 2023. Continued 5G and fiber subscriber gains. 424,000 postpaid phone net adds. 11 straight quarters with more than 400,000 net adds with continued low postpaid phone churn. 272,000 AT&T fiber net adds. 13 straight quarters with more than 200,000. High quality customer additions continue to drive revenue growth. Domestic wireless service revenue is up 5.2%. Best ever first quarter mobility operating income. Consumer broadband revenue up 7.3%. And that's driven by AT&T fiber revenue growth of 30.7%. Network enhancement and expansion momentum. Mid-band 5G spectrum covering more than 160 million people. Reliable nationwide 5G reaching 290 million people. That's a lot of people. Ability to serve fiber to 19.7 million consumers and more than 3 million business customer locations. And that's in more than 100 US metro areas. And they remain on track to pass 30 million locations by 2025. They're on track to achieve $6 billion plus run rate cost savings target before the end of the year. First quarter results, revenue of $30.1 billion, diluted EPS of 57 cents compared to 65 cents in the prior year, adjusted EPS of 60 cents compared to 63 cents in the prior year. The main difference between adjusted and non-adjusted is that they remove stock-based compensation in adjusted. They also remove other things, but it's mainly stock-based compensation. Cash from operating activities, $6.7 billion, CapEx, $4.3 billion, capital investments, $6.4 billion, and free cash flow of only $1 billion. Revenue in the first quarter of $30.1 billion versus $29.7 billion a year ago, up 1.4%. The increase is mainly from higher mobility, Mexico, and consumer wireline revenues, partly offset by lower business wireline revenues. Remember earlier we looked at business wireline, and that's down a lot. It's at its lowest point ever. $24 billion of operating expenses, similar to last year. Operating expenses decreased mainly due to lower domestic wireless equipment and associated selling costs from lower sales volumes. First quarter 2022 3G network shutdown costs, lower personnel costs, and higher return on benefit-related assets. The decreases were offset by higher amortization of deferred customer acquisition costs, higher bad debt expense, and increased depreciation. Additionally, business unit costs included year-over-year increases due to inflation. Operating income was $6 billion versus $5.5 billion last year. When adjusting for certain items, adjusted operating income was $6 billion versus $5.8 billion. Equity and net income of affiliates was $500 million, mainly from DirecTV. Income from continuing operations was $4.5 billion versus $5.1 billion. Earnings per diluted common share from continuing operations was 57 cents versus 65 cents. Adjusting for 3 cents, which includes our proportionate share of intangible amortization from DirecTV. Cash from operating activities from continuing operations was $6.7 billion, down nearly $1 billion. And that's due to timing of working capital, including lower securitizations, CapEx of $4.3 billion versus $4.6 billion. Capital investment includes $2.1 billion of cash payments for vendor financing, totaling $6.4 billion. Free cash flow was $1 billion for the quarter. Total debt was $137.5 billion. Net debt $134.7 billion. They expect to achieve a net debt to adjusted EBITDA ratio in the 2.5x range by early 2025. For the communications business, first quarter revenue $29.2 billion, up 1%, due to increases in mobility and consumer wireline, which more than offset a decline in business wireline. $6.7 billion of operating income, up 3.9%. Operating income margin of 23% compared to 22.5%. In mobility, revenue up 2.5%, and that's at $20.6 billion due to higher service revenues offset by lower equipment revenues. Service revenues were $15.5 billion, up 5.2%. That's driven by subscriber and postpaid ARPU growth. ARPU is average revenue per user. Equipment revenues were $5.1 billion, down 4.7%, driven by lower volumes. Operating expenses $14 billion, down 0.5% year over year, primarily due to lower equipment costs driven by lower device sales. First quarter 2022 3G network shutdown costs and lower content costs. That's offset by increased amortization of deferred customer acquisition costs, higher network and customer support costs, higher marketing costs, and higher bad debt expense. Operating income was $6.3 billion, up 10%. Operating income margin 30.5% compared to 28.3%. EBITDA was $8.4 billion, up 8%. EBITDA margin 40.7%, up from 38.6%. This was the company's best ever first quarter mobility EBITDA. EBITDA service margin 54%, up from 52.6%. EBITDA is earnings before interest, taxes, depreciation, and amortization. 5.1 million wireless net adds, 542,000 postpaid net adds, with 424,000 postpaid phone net adds. They did lose 56,000 in postpaid tablet and other, 174,000 other net adds, 40,000 prepaid phone net adds. Postpaid churn was under 1%. Churn is a percent of people that stop using the service. That's compared to 0.94% the prior year. Postpaid phone churn 0.8%, which is similar to last year. Prepaid churn was 2.7%, with Cricket substantially lower versus 2.8%. Postpaid phone ARPU was 55, up nearly 2%. And that's due to prior year pricing actions, higher international roaming, and a shift to higher price paid unlimited plans. FirstNet connections reached 4.7 million across more than 25,000 agencies. FirstNet is a nationwide communications platform dedicated to public safety. AT&T and FirstNet cover more than 99% of the US population, and FirstNet covers more first responders than any other company in America. Let's look at business wireline. Revenue $5.3 billion, down 5.5%. This is due to lower demand for legacy voice and data services and product simplification, offset by growth in connectivity services. Operating expenses $5 billion, down 1%. That's due to lower personnel and other costs associated with ongoing transformation initiatives, lower wholesale network access costs, and lower marketing costs, offset by favorable compensation items and increased depreciation expense. Operating income $378 million, down 41%. Operating income margin 7% compared to 11%. EBITDA was $1.7 billion, down 12%. EBITDA margin 32% compared to 34%. AT&T Business serves the largest global companies, government agencies, and small businesses. More than 750,000 U.S. business buildings are lit with fiber from AT&T, enabling high-speed connections to more than 3 million U.S. business customer locations. Nationwide, more than 10 million business customer locations are on or within 1,000 feet of their fiber. Consumer wireline. Wireline means a cable, not wireless. Revenues were $3.2 billion, up 2.5%. And that's due to gains in broadband more than offsetting declines in legacy voice and data and other services. Broadband revenues increased 7% due to fiber growth of 30.7%, partly offset by a 13.6% decline in non-fiber revenues. Operating expenses $3 billion, up 4.8% due to higher depreciation expense, higher network and customer support costs, and increased amortization of deferred customer acquisition costs, partly offset by lower sales, advertising, and content costs. Operating income was $94 million, down 41%. Operating income margin 2.9% compared to 5%. EBITDA was $955 million, up 3.2%. EBITDA margin 29.5%, up from 29.3%. Total broadband net losses, excluding DSL, were 23,000, reflecting AT&T fiber net adds of 272,000, more than offset by losses in non-fiber services. AT&T Fiber can serve 19.7 million customers. Let's look at their Mexico Latin America division. Revenue $883 million, up 28%. That's due to growth in both service and equipment revenues. Service revenue $591 million, up 21%. That's driven by favorable foreign exchange, higher wholesale revenues, and growth in subscribers. Equipment revenues were $292 million, up 46%, due to higher sales and favorable foreign exchange. Operating loss was $30 million compared to $102 million. EBITDA was $145 million compared to $59 million. Total wireless net adds were 10,000, including 58,000 prepaid net losses, 49,000 postpaid net adds, and 19,000 reseller net adds. So this division is doing really well. Percent-wise, it's probably improved the most. Let's go through their PowerPoint slides from their first quarter presentation. All this information you can find on their website. 2023 business priorities: grow durable 5G and fiber relationships, execute consistent and disciplined go-to-market approach, deliver targeted solutions for underpenetrated segments, generate value by creating and maintaining long-term customer relationships, effective and efficient in everything we do, achieve $6 billion plus run rate cost savings target, transform network to enable copper footprint rationalization, target incremental margin expansion with additional cost structure improvement, deliberate capital allocation, invest for long-term growth, 5G and fiber, strengthen balance sheet by reducing net debt. I know that's a big one. Provide an attractive dividend with improving credit quality. They do have an attractive dividend. Credit quality is questionable. Postpaid phone subscribers, 70 million, up from 67.5 million in 1Q 2022. And the average revenue per user went from 54 to 55.05, so they're improving in both categories. Mobility service revenues, 14.7 billion to 15.5 billion. And that 14.7 billion is up 4.8% from 1Q 2021. And this most recent quarter is a 5.2% increase from 1Q 2022. Mobility EBITDA, 7.7 billion up to 8.4 billion. And their margins are improving, 52.6% to 54.1%. Fiber subscribers, 6.3 million to 7.5 million. Revenue per user is up from 60.41 to 65.92. Fiber revenue, 1.1 billion to 1.5 billion. That's an improvement of 31%. Consumer wireline EBITDA up a little from 900 million to 1 billion. Margin is up from 29.3% to 29.5%. I know we discussed a lot of these numbers earlier in the video, but the key to learning is repetition. And these slides show the numbers in a different format. With all the visuals, it may make it easier for you to absorb. First quarter revenue of 30.1 billion, up from 29.7 billion. Adjusted EPS, that is down from 63 cents to 60 cents, but their margins are up from 19.4% to 19.8%. Cash flow from operations down from 7.6 billion to 6.7 billion. Free cash flow is down a lot from 2.8 billion to 1 billion. Revenue growth driven by subscriber and ARPU gains. Revenues of 30.1 billion, up 0.4 billion. Mobility service revenue growth of 5.2%. Consumer broadband revenue growth of 7.3%. Adjusted EPS of 60 cents. This includes a detraction of 6 cents from higher pension costs, lower DirecTV contribution, and a higher tax rate. Cash flow from operations, 6.7 billion. 1 billion of free cash flow, reflecting seasonality, capital investment cadence, and timing of working capital. Includes 1.3 billion from DirecTV. CapEx of 4.3 billion, capital investment of 6.4 billion, up from 300 million, includes 2.1 billion of vendor financing payments. Their first quarter mobility results, revenue up from 20.1 billion to 20.6 billion, EBITDA up from 7.7 billion to 8.4 billion, and their EBITDA margins are up too, 38.6% to 40.7%. Postpaid phones, 595,000 to 691,000. Now it's currently 424,000. And the churn is getting higher. You don't want a higher churn. It's 0.81% in the first quarter of 2023. Strong revenue and EBITDA growth from high quality subscriber and ARPU gains. Wireless service revenues grew 759 million, up 5%. EBITDA of 8.4 billion, up 8%. Postpaid phone ARPU of 55, up nearly 2%. Continued strong EBITDA and service margins from sustainable go-to-market strategy and cost transformation. Consistent and disciplined execution as industry growth normalizes. 424,000 postpaid phone net additions. Continued low postpaid phone churn of 0.81% as improved value proposition continues to resonate with customers. Now let's look at their consumer and business wireline. So for consumer, revenue flat at 3.2 billion. EBITDA is up from 900 million to 1 billion. EBITDA margin is up from 29.3% to 29.5%. Business wireline is down from 5.6 billion to 5.3 billion. EBITDA is down from 1.9 billion to 1.7 billion. And EBITDA margin is down from 34.4% to 32%. So for consumer wireline, revenue and EBITDA growth driven by fiber adoption, with fiber revenues up 31%. Broadband revenues grew 7% with fiber subscriber growth and mix shift to fiber. Fiber ARPU of 66 up 9% with intake ARPU about 70. Strong AT&T fiber growth with 272,000 net additions even with significantly lower move activity. Business wireline results impacted by ongoing transition toward core connectivity. Portfolio rationalization impacted year-over-year comparisons. First quarter 2023 EBITDA comparability impact by $50 million in favorable items in the prior year. Business Solutions Wireless Service revenues grew nearly 7%. FirstNet added 300,000 connections. So to summarize, I have them trading at a 38% discount. They've been around 40 years. They are a giant of a company. They still pay a massive dividend. And if you bought this stock now at the lows and say the stock doubled, it went from about 15 to 30, and say they still paid 7% on that $30 stock price, your yield would not be 7%, it would be 14% because your cost basis would be $15. Some people own stock for so long that their yield is over 100%. And some people don't have a yield over 100% annually, they have over 100% by quarter. That's why the stock market is a long-term game. And you want to put your money in winners like AT&T, not in losers like Nvidia. No, I'm just kidding. Nvidia is a great company. I rank their free cash flows 5 out of 10, their revenue 8 out of 10, and their ratios 8 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to become a member, you can click on the link in the description below. Thanks for watching.